Cash flow or capital growth? Which one's better? I'm going to cover it all today. Hey everyone, Andy Trin from Tax here for another video designed to help you become a better property investor. Every property investor is looking for the unicorn of property investing success. In fact, some spend years searching for the mythical investment strategy that will help them on their path to financial freedom. But unfortunately, too many investors get caught up in the battle between whether to buy cash flow or capital growth. And because of this fixation, so many miss out on the golden opportunities that could have helped them achieve their financial goals and dreams much earlier. Everyone will have their own opinion on why capital growth beats cash flow every time, or why cash is king. But maybe the secret lies in buying property that allows you to focus on a little bit of both. There's this common misconception that if you choose property based on cash flow, you risk missing out on capital growth, but that's not necessarily the case. Both capital cities and regional locations have the potential for capital growth and cash flow. You just need to know how to find these properties. So in today's video, I want to talk about cash flow and capital growth means and how you can make the most of both strategies in your investment plan. But before we start, we want to be clear that this video is for informational purposes. In no way should you interpret this as financial or tax advice. We always recommend working with a qualified financial advisor or tax agent to give you the best advice for your situation. Alright, let's get straight into it. Before you decide between cash flow and capital growth, you need to know the fundamentals that underpin each concept. A cash flow strategy is a simple and tempting philosophy to follow. It involves investing in properties with high potential rental yield and a rental income that is greater than the total expenses of holding the asset. In other words, all your investment property expenses like maintenance, home loan interest, and management fees are covered by the rental income you generate. And then if you have any extra funds, you can use that to pay down the loan and increase the property's equity. As we mentioned earlier, investors often believe if they're going to go the cash flow route, they have to be willing to accept lower growth rates. We'll discuss why this might not necessarily be the case a bit later on. But for now, if your goal is eventually to retire and live off your property income, then positive cash flow properties may be your focus. You can buy investment properties that deliver a strong return, and once you reach your desired passive cash flow, you can choose whether or not to keep working and live off your property income. The philosophy here is that regardless of capital growth outcome, when we're old and retired, we want to live off a stream of passive income. We can't live off capital growth. Another point to consider in favor of cash flow properties is that cash flow is what helps you build your portfolio. If you apply for a loan to buy a property, the first question the lender asks is, can you pay back the loan? Wherever your income is coming from, it all gets taken into account. And if you don't have enough income, then you may not qualify for the next stages of the loan process. So cash flow is good for serviceability. On the flip side of the coin, you have just as many advocates for a capital growth strategy. Capital growth properties are essentially the ones that significantly increase in value within the time you're looking to sell. And the argument with a lot of investors is that it is the only way to create real wealth. In fact, many of these investors debunk the theory that cash flow will help you buy your next property. The argument essentially is that from an income perspective, most people only have the capacity to invest in one property at a time. These days, you can't invest in property without a deposit, and it's always been hard to save up for one of those. But the key to growing your portfolio is buying more property, which then requires more deposits. It's highly unlikely that many people can save multiple deposits over their lifetimes, but what they can do is use the capital growth or equity in their properties instead. According to the capital growth advocates, if they had invested in cash flow properties, sure, they would have solid rental income, but that generally won't do anything to help you with a deposit for your next property. So those are the two different strategies on how each could be beneficial depending on what your goals are. The most ideal situation to be in, obviously, is to own properties that don't necessarily cost too much to hold, but that also offers long-term capital growth. So in other words, you want to find properties in areas that are growth focused, but have a strong demand for rental. This way, you can enjoy the best of both worlds by securing both growth and positive returns in the long term. In fact, some investors even argue that you can't sustain success without doing both. Because if you only chase growth, you'll run out of serviceability because you'll get to a point where the bank won't lend you any more money because the cash flow isn't there. But you also need growth properties to build your long-term equity. The main fault in creating a debate about which strategy is better is it fails to recognize that smart investors take a holistic approach to their multi-property portfolios. And healthy portfolios are balanced. That way, depending on the investor's requirements at a given point in time, the portfolio can be weighed slightly towards cash flow or capital gain. Your property portfolio doesn't have to be built on a one strategy approach, but could consist of a mix of property types that will service the investor's immediate needs with a long-term perspective on wealth building. Each and every purchase needs to be deliberate and have a desired outcome that makes sense to the overall balance sheet. You shouldn't let anyone tell you that property investment is a set and forget proposition, because successful investors ensure that their portfolio is reviewed consistently and periodically so their next purchase will be perfect for their requirements. The best investments find a balance of both cash flow and capital gains, where you can earn a decent cash flow in the short term while realizing a healthy capital gain in the long haul. And the best way to create a balanced portfolio is to have a team of property experts in your corner. A mortgage broker will help you find a loan product that is best suited for maximizing your return on investment. A financial advisor will ensure that you are making the right decisions to make financial sense. A quantity surveyor and accountant can help you maximize all your investment property tax deductions for better cash flow. And a property investment advisor can help you purchase your investments for the best possible outcome. You don't need to do this alone. In fact, you shouldn't. Anyway guys, that's it from me. Hopefully there were some useful points you could extract from there to help you in your investment journey. If you know anyone who might find this useful, please make sure to share this video with them. I'm Andy Trin from Tax. See you next time.